gentlemen, I'm Elisa Trovato, broadcasting from the FT offices in London, where we are conducting our latest PWM interview. Our subject today is private equity, the democratization of this asset class, the opportunities and risks that come with it, and the lessons that wealth managers and their clients can learn from institutional investors and their investment models. To discuss these topics, I'm delighted to be joined by Mike O'Sullivan, Chief Economist at Moonfare, book author of The Leveling, and previously at Credit Suisse, where he was Chief Investment Officer in the International Wealth Management Division. Hello, Mike, and
hello, Elisa.
To our studio.
Nice to be here. Yeah.
Mike, in an environment where the diversification provided by the traditional balanced equity fixed income portfolio is increasingly called into question, should wealthy clients take inspiration from institutional investors who allocate a large part of their portfolio to alternative illiquid assets like private equity?
So I guess, Elisa, we're chatting about what's called the endowment model, where I guess principally in the States, going back to Yale University and some of the other big universities, they've allocated quite aggressively in some cases and generously to private equity venture, partly because they have access to funds in those segments, partly because they have a long-term investment outlook. And I think there's a few reasons that I, as an economist, find it very, very interesting. If you look at Europe's stock market indices, they haven't done an awful lot in the last couple of years. It looks quite dull, but there's an awful lot happening in the economies. People talk a lot about AI, and in the public markets, there's really only a couple of AI stocks, and arguably they're very, very expensive and very, very crowded. But if you look at the venture sector, there are loads of up-and-coming AI stocks, quantum computing stocks, and then even in the private economy, private equity transactions, buyouts, infrastructure. So effectively, what's happening is that public markets are kind of shrinking. There are fewer companies coming into public markets, and there's all this activity in the private sector. And if you are a private investor, it's actually quite hard to A, make sense of all of this, and B, to get access to it.
Earlier this year, we conducted a survey where we asked investment and asset allocation intentions of CIOs and heads of asset allocation at 54 major private banks, managing a combined $22 trillion in client assets. They say that the private equity or private markets in general are the areas in portfolios where there is the greatest misalignment between client allocation and chief investment officers' recommendations. More than a third of CIOs indicate that clients have a smaller allocation to private assets and private equity compared to what they recommend. They mentioned, the main hurdles being lack of education of clients, long lock-up periods, illiquidity, large ticket sizes. Do you think these issues are being addressed by the industry, and are there other issues we are not aware of?
Yeah, so many of these people are former friends and former colleagues of mine, still friends, I should say. So I recognise what they're saying. There's a whole range of issues, and again, if you're an allocator across asset classes, private equity venture give you a lot of diversification. In terms of educating investors, they're actually quite good because they force people to take a long-term view of particular trends and also of economies. One issue is access, actually being able to get to know and build relationships with the big private equity houses, some of the venture houses. It takes quite a bit of time to build up credibility. The other is education, both of the clients and also people within the actual private banks or asset managers themselves, because private equity is complex in terms of the various payouts, but also some of the underlying investments themselves. So you need to invest education and time in it. And then the other thing I think that I'm beginning to find is just getting a sense of how to build a diversified portfolio. Because very often what happens is that some clients and some private banks will invest in one or two funds, but won't, for different reasons, won't actually build out a portfolio of private investments across things like infrastructure, secondaries, buyout funds, venture, that each one will perform in different ways according to different megatrends in different parts of the cycle. As a final point, I mean, what's happening in the industry now reminds me of some of the things I've seen in the 2000s with other parts of the financial services industry. It's just beginning to open up, and I think in the future, the idea of the sort of the portfolio of the future will have a lot more private equity and venture in it. The really tough thing is just being able to pick the good funds and get access to them. But if you look at the private equity universe, the dispersion or the difference between the best performing funds and the worst ones is enormous, up to like 25-30%. And that's a really, really big issue over time, because you're talking about how these returns compound over time.
In what way can technology support the democratization of private markets and private equity in particular?
Yeah, so technology is just linking everything, and many of the investments in private equity, infrastructure, venture, they're all led by new technologies and new innovation. And again, if you read the FT and you hear people talk about these glittering new technologies, the private asset space is really the only place you'd be able to invest in these. Secondly, the managers themselves are beginning to use technology to try and do better diligence for admin, and also I think to try and identify good companies and filter through the opportunities they're seeing. And then in terms of access, you are seeing a small number of platforms who, with technology, are able to offer people, really good information on what good funds are, access, and education. But it's still a very, very small number.
And also, I guess these platforms are also making it possible to invest in smaller sizes.
They are, exactly, and there are regulatory changes too. So in Europe we have the ELTIF model, which basically means that smaller investors with smaller amounts of money can access private assets in certain ways. And this, I think, is a very, very welcome step. The one thing I would say is that I don't expect private equity and venture to become commoditized in the same way you get trading platforms for equities, because there's a very limited number of platforms who actually have the relationships with the funds. There's still a great deal of education to be done and information to be imparted.
So looking forward, what are the risks of investing in private equity in the current market conditions? We've seen distributions from private equity funds have slowed. Many firms are struggling to hit their fundraising targets. What do you expect?
So there is a sort of capital markets issue going on at the moment, both in Europe and the States. There are not many people in venture and private equity doing deals as actively as they were in maybe the last 5 or 10 years on average, partly because of risk aversion on the outlook. You mentioned distribution. So there is a sort of, how would I say, a process where private equity firms will invest in a business, then a few years later they'll sell it and they'll distribute the cash to the investors in the fund, and that's happening at multiple cases, multiple levels. And those distributions are not happening because, well, one reason is that the IPO market is not working. What we're now seeing is you're seeing the advent of secondary funds, and secondary funds in private equity and venture, they come along and they buy some of the investments that the private equity venture firms have made at a discount. So they're getting these companies at a lower price, and effectively that's recycling capital through the industry. And there's been some really big capital raises by some of the big secondaries funds in the last year. It's one of the more active areas.
Mike, thank you very much for
Pleasure.
your insights.